Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about T-Mobile US Inc. Annual Report. T-Mobile US Inc. offers a wide range of services and products to its customers. At the core of their business are wireless communication services, which include voice, messaging, and data services for postpaid, prepaid, and wholesale customers. The company also provides various devices such as smartphones, wearables, tablets, home broadband routers, and other mobile communication devices. In addition to these services, T-Mobile offers financing through equipment installment plans, reinsurance for device insurance policies, and extended warranty contracts, and high-speed internet services. They provide products and services under 3 distinct brands: T-Mobile, Metro by T-Mobile, and Mint Mobile. These brands are available through various channels, including owned retail stores, customer care channels, national retailers, and their websites. T-Mobile also sells devices to dealers and other third-party distributors for resale through independent retail outlets and online marketplaces. This allows customers to purchase products from a variety of sources, increasing convenience and accessibility. Overall, T-Mobile's diverse range of services and products makes them a comprehensive provider in the wireless communications industry. T-Mobile US Inc.'s stock price has experienced a significant drop of over 15.8% in the past year, with its value declining by approximately 21.88% to 22.05%. This substantial decline was influenced by a series of events and market reactions rather than a single incident. One key factor contributing to this downward trend is the Q4 2025 earnings report and outlook released in February 2026. Despite surpassing Wall Street's expectations for earnings per share, EPS, and revenue, the stock experienced a pre-market decline due to investor concerns about future growth prospects and subscriber additions falling below expectations. Additionally, T-Mobile's workforce restructuring efforts, which included laying off 393 workers in Washington by April 2, 2026, also contributed to the broader investor sentiment during this period of stock price decline. The company's plans to reset costs while funding network and broadband expansion likely impacted investor perception. The overall market and competitive pressures within the telecommunications industry have also played a significant role in T-Mobile's stock performance. Rivals offering aggressive deals to attract new customers created a tough competitive environment, which likely affected investor perception and contributed to the stock's decline. T-Mobile US Inc. market capitalization of $247 billion is significantly larger than the average industry peer of roughly $4 billion. This shows that T-Mobile US Inc. holds a significant advantage in their industry. T-Mobile US Inc. trades at a higher price-to-earnings ratio of 21 times and a higher price-to-book ratio of 4.11 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 70% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The income statement shows that the company revenue have been declining annually even though operating income have been improving. Although the drop in revenue is concerning, we can tell that management have been able to reduce cost. The primary drivers of revenue growth or decline can be categorized into several key areas. Firstly, an increase in service contracts with customers has led to a rise in wireless communications services revenue. Additionally, the growth in premium services, such as device insurance services, has also contributed to this increase. In terms of equipment revenues, sales of mobile communication devices and accessories have been a significant driver of growth. Furthermore, financing options for customers to pay for devices and accessories in installments, EIP, have also played a crucial role in revenue growth. However, there are also factors that may impact revenue growth or decline. Changes in contract terms, such as down payments, can affect the collectibility of transaction price. Imputed interest on EIP receivables and capitalized contract costs can also impact revenue recognition over time. Other drivers of revenue growth or decline include the acquisition of Kaena's prepaid customer relationships, diversification of brand identities and distribution footprint, and expected growth in customers and service revenues from the operations of the combined company. These factors highlight the importance of strategic decisions and market trends in driving revenue growth or decline. Net income experienced a significant fluctuation between the years of 2023, 2024, and 2025. In 2023, net income was $9.053 billion, which increased by 25% to $14.7 billion in 2024. However, this upward trend was short-lived, as net income decreased by $400 million from 2024 to 2025, resulting in a net income of $14.3 billion. The change in profit margins also followed a similar pattern. Between 2023 and 2024, profit margins increased due to the significant increase in net income, despite a relatively small change in operating activities cash flow. However, this upward trend was reversed between 2024 and 2025, with profit margins decreasing by approximately 0.5% or 1.6 percentage points. The decrease in profit margins can be attributed to the decline in net income during this period. The fluctuations in both net income and profit margins can be attributed to various factors such as changes in operating activities, cash flow, revenue growth, and expenses. Despite these fluctuations, the company's overall financial performance remains strong, with a net income of $14.3 billion in 2025. The company's financial performance is a testament to its ability to generate positive operating cash flow. According to the data on page 50, in 2025, the net cash provided by operating activities reached $27,950 million, marking a significant increase of 34% from 2023 and 25% from 2024. This upward trend is a clear indication that the company's operations are becoming more efficient and profitable. The substantial increase in operating cash flow suggests that the company is effectively managing its resources and generating sufficient revenue to cover its expenses. As a result, the company is able to generate positive operating cash flow, which is a crucial indicator of financial health. The data on page 93 further supports this conclusion, showing that net cash provided by operating activities in 2025 was $1,372 million, while in 2024 it was $1,468 million. Although there is a slight decrease from 2024 to 2025, the overall trend remains positive, indicating that the company's operations are generating sufficient cash flow to support its growth and expansion. The company's debt level and interest expenses have undergone significant changes in recent years. According to the extracted summaries, the total debt has increased substantially from $78,265 million to $86,282 million, representing a rise of $8,017 million. This increase is also reflected in other pages, with the total debt rising by $9.393 billion and $1,756 million. The interest expenses have also seen a notable change, increasing by 11% from one year to another. Specifically, the interest expense, net, increased by $363 million, while the amortization of accumulated other comprehensive loss into interest expense, net, has contributed significantly to this change. Overall, the company's debt level and interest expenses have experienced significant fluctuations in recent years. Management is optimistic about the company's outlook, citing increased competition in the telecommunications industry as a driver of growth. The acquisition of UCellular is expected to bring significant synergies, including enhanced rural 5G coverage through the combined network footprint. However, this deal also comes with a price tag, with an estimated increase to cash income tax liability of approximately $850 million upon transaction close. In terms of investments and capital contributions, management expects to make an additional capital contribution of around $500 million between 2027 and 2028 under its existing business plan. This investment is expected to yield a long-term rate of return on investments for funding purposes of 8% by the end of 2026. Management is also focused on managing risk through various initiatives, including the use of derivatives to mitigate exposure to market fluctuations in foreign currency, exchange rates, and interest rates. Additionally, the company has entered into cross-currency swaps to offset changes in the value of its payments on foreign-denominated debt in USD. Overall, management's strategy appears to be centered around leveraging the acquisition of UCellular to drive growth and increase competitiveness in the telecommunications industry. While there are some risks associated with this deal, including potential losses due to ongoing legal proceedings and inquiries, management is confident that the benefits will outweigh the costs. The company has made several significant acquisitions and divestitures in recent years. On the acquisition side, one notable deal is the UCellular acquisition on August 1, 2025, which was detailed on page 15 of the financial report. The company also established joint ventures for establishing fiber broadband networks, merged with Sprint Corporation, and entered into a license purchase agreement with Comcast. In addition to these deals, the company acquired Ka'ena in May 2024, with an additional $420 million in future cash and T-Mobile common stock payable in satisfaction of the earnout. The company also jointly acquired Lumos in April 2025, with an additional capital contribution of approximately $500 million between 2027 and 2028. On the divestiture side, the company sold its prepaid wireless business to Dish Network Corporation and sold its wireline business to Cogent Infrastructure, Inc., for a total consideration of $700 million. These transactions demonstrate the company's efforts to streamline its operations and focus on key areas of growth. The company has a history of returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company has consistently paid out significant amounts each year, with totals reaching $4.1 billion in 2025, $3.3 billion in 2024, and $747 million in 2023. In addition to paying dividends, the company has also been actively buying back its own shares. In 2025, it repurchased 42.36 million shares for a total of $9.9 billion, while in 2024, it bought back 59.38 million shares for $11.1 billion. The company's share buyback activity continued in 2023, with the purchase of 15.46 million shares for $2.2 billion. Overall, these actions demonstrate a commitment to returning value to shareholders and maintaining a strong capital structure. Concerns about inventory buildup and supply chain disruption have been raised due to recent trends. Inventory levels increased significantly in 2025, with a notable rise from $1,607 million in 2024 to $2,405 million in 2025. This increase is accompanied by a decrease of -$615 million in 2025, indicating fluctuations in inventory management. Supply chain disruptions are also a concern, primarily due to trade policies and increased costs. Suppliers may struggle to absorb these costs, potentially leading to disruptions or cost pass-throughs. The significant investment in purchasing property and equipment for the nationwide 5G network has further contributed to supply chain complexities. These factors suggest that inventory buildup and supply chain disruption are indeed concerns that need attention. That concludes the financial summary for T-Mobile US Inc. Feel free to comment below, and I will be happy to answer them when possible.